Hey YouTube, welcome back to Love for Crypto. It's been a while since I've done a video. Been busy at work, summertime. Workload's gone through the fucking roof. I've not been able to spend as much time as I usually would do. Obviously going over the latest developments in the space. Scott's been doing a great job of keeping you up to date on the daily vlogs that he makes, with the daily news that's coming through. But I'm making this video today as another economic outlook. If you've been following the channel, you obviously know that I enjoy doing these types of videos, although half the time I don't actually know what the fuck I'm talking about. But I have a good grasp of obviously the direction of the monetary policy, the way the geopolitical landscape, how things are. I was going to make this video with some illustrations, just to show you exactly the warning signs for recession. I'd like to think that a lot of you actually, you know, you've got all your data points that you need, for example from the Federal Reserve and other central banks across the world. But today was a very significant milestone in the world. We today passed $15 trillion in negative yielding bonds. That's basically meaning, you know, as an example, I've got $100 million. Well, not dollars, because the US is probably one of the only banks that have actually got positive yielding bonds at the moment. You look over to the European Union, various other nations across the world. And another thing as well, you know, even if you're looking at a 1% yielding bond, the reality of it is still a negative yielding bond, because obviously once you're pricing inflation, it takes away that 1% and probably puts it at minus 1%. But today, we passed the $15 trillion milestone of negative yielding bonds. And as I was about to mention, if I've got $100 million worth of value and I'm going to put put this capital into a bond, I'm basically paying the central bank for me to give me for me giving me my money to those. So you know, it makes zero sense. You know, usually our bond would work, you know, a 3.5% yielding bond over a 5-year term. You know, I'd give them, you know, for example, $1 million, and then I should be expecting to yield 3.5% back on top of my initial investment. The way that negative yielding bond works is I'm giving you $100 million in the expectation of knowing that I'm going to get less back. So it's quite a significant thing actually. It's quite a crazy world that we're living in, with negative interest rates absolutely going through the roof. I think last week it was at 13.2 trillion, and today we've now crossed the 15 trillion milestone. Obviously there's all sorts of other leading indicators as well that we're seeing. One thing I do want to put across to you, ladies and gentlemen, I think if we go back to October 2018, I was speaking about how the Federal Reserve are losing control of things. You know, obviously we was going through quantitative tightening, we was unwinding the balance sheet that the Federal Reserve has accumulated since the Great Recession that we had in 2008. A lot of people laughed at me when I did say we're going to start seeing interest rate cuts, not increases, cuts. People will say it's going to destroy the value of the dollar. Listen, it was unsustainable. The path, the tightening was absolutely gripping the US financial sector by the bollocks and making it hemorrhage from the brain. It was never going to work. It was never sustainable. It just goes to show, you know, the Federal Reserve, the way that they're plastering it on the mainstream media about this great thriving economy and how they want to keep the expansion going. Just another fascinating fact you need to take into consideration, and this is an historical fact. And although they do say history isn't always replicated, but it rhymes, well, here's a fascinating point for you today. Every single time that the United States have decreased interest rates, 6 months later a recession has followed. Now obviously we've had the pause from the Federal Reserve in March. They left the Fed base rate unchanged, and as of recently, I've been meaning to do this video for a while. Again, I did want to have illustrations to show you actual diagrams, to show you these indicators and how severe the warning signs really are now, and especially with the Federal Reserve decreasing interest rates by 0.25, and then Donald Trump coming out the next day saying it wasn't enough. and we've just heard that China have devalued their currency again, obviously in retaliation to the 0.25 basis point drop, 25 basis point drop of the Fed funds rate. China have come out and devalued their currency to a historic all-time low, and not a historic all-time low, but we've not seen these types of devaluations since 2008. So obviously the Federal Reserve have come out, they've decreased interest rates by 0.25. China have now obviously decreased their currency by even more, and the reason being so is obviously the tariffs that Donald Trump are placing on the Chinese trade. Obviously the retaliation is for China will just decrease our money, and it just completely eliminates those tariffs altogether, and it's the US consumers that are ended up paying that extra capital. It's a really historical point we're actually at here, and I've been very excited to make this video because, as I just mentioned, every time the Federal Reserve has paused and then decreased, 6 months later a recession has followed. Now, as you can see by the data points around the world, the figures we're seeing, whether it's manufacturing, whether it's car sales, home sales, we're seeing a slowdown across the globe. It's all over our faces. You know, they can sugarcoat it as much as they want, Donald Trump, with the great economy. You know, one thing I will say, the US economy is way better shape than most economies around the world, but although the US economy is on its arse at the same time, it just goes to show that other places around the world are also on its arse. We've just seen a 0.25 basis cut rate from the Federal Reserve. It's now been priced in to see a 0.5 interest rate cut, 50 basis point cut reduction in September. Listen, we're now into a full-blown currency war now. Every time that the US is going to devalue their currency by dropping interest rates, by adding supply, by devaluing their currency, you're going to see retaliation from the second largest economy in the world, which is China, and it's going to be so on and so on. And a lot of economists that I do listen to, especially the gold bugs, they're calling it a race to the bottom. So as each major nation devalues their currency for a greater revenue on exports, you're going to see the next nation doing the same, and it's just a knock-on effect. But irrespective to all that anyway, these these interest rate cuts were coming. We've seen in December when we've seen an absolutely huge sell-off just before Christmas, and then we've seen obviously the Santa Claus rally follow after that. But we're talking substantial losses where we've seen the Dow, you know, every week at least stripping 1,000 points, bouncing back 400, couple of hundred the next day, and 900 loss again. We've just seen the 6th largest decrease in the US equity markets in history the other day, when I think we briefly just touched 1,000 points. I think we closed at 800 points down on the Dow Jones Industrial Averages. And you know, we are at that fucking turning point in life. I've been saying this for so long now, and listen, I'm not a fucking economist, I'm not a financial advisor. I listen to the right people who are giving out sound information, unbiased information. Some people call it the alternative media. I call it the real media, because the state-owned media that you see is portraying a narrative onto the everyday person to have the impression the economy is doing great. Don't worry about inflation and all these sorts of other propaganda, you know, obviously outlets, your CNBCs, and you know, they do not tell you the truth until it's too late, which obviously at that point is too late. So obviously, as you can see, gold's been doing extremely well as well. I think it's broke its 6-year high recently. I think it's trading around 1450 spot price. I think there's a good chance with these currency devaluations and another potential 50 basis point reduction on the Fed side. You know, we could easily see that creeping up into the 1550s, 1600s within the very short term future. And as you can see, again, I've not got the charts, which I'm a bit disappointed about, but as you can see, around the world, I think gold's now hit 6 all-time highs against emerging market currencies, as those currencies themselves are really struggling. Gold's now reaching all-time highs. You can see the correlation on the graph. Obviously driving, it's going to be a bit difficult for me to obviously try and paint that picture. But gold's true value, you know, people use it more as a store of value. If you look at like the Turkish lira, you'll probably find that gold's at its all-time high, but that's obviously because of the devaluation of the Turkish lira itself. No, gold's not necessarily doing anything, but as currencies lose value, it gives the impression that gold's going up. Now, obviously, of course, investors are rushing into gold as a safe haven investment during these uncertain times. But I can assure you one thing, ladies and gentlemen, from all the education and all the research and all the deep dives that I've done, you know, not just in the cryptocurrency space, you know, I'm talking on the geopolitical space, on a macro, you know, economic scale as well. We're really at that critical point now. If you've been following this channel, you know I've always talked about Q4 2019 leading up to Q2 2020 to really see the telltale signs of the recession. Now, I'm not outright saying this is where we're going to experience the currency crisis itself. I believe that's a little bit further down the line, around 2021, from the research that I've done and from the information and data points that I've absorbed into my mind. I believe that's probably the real dollar crisis, if you want to call it the dollar liquidity crisis, will follow around 2021. But make no mistakes about it, Q4 2019 leading into Q2 2020, we will be in recession. I've stood by this prediction now for months and months, if not years, probably leading around 18 months, I reckon, for this outlook itself. And obviously I make these videos every now and then. It's probably been a couple of months since my last one, but if you do look through the videos, I do not change the goalpost. I keep my prediction, my outlook as honest as I can do, without trying to change it so it makes myself look better. Listen, I might be wrong about it. I've never said that I'm fucking perfect. But listen, a lot of stuff that I fucking talked about so far has come to fruition. When everyone was laughing and mocking me, saying that they're not going to decrease interest rates, it'll destroy the dollar. Look what happened. We've just had a 25-point basis reduction from the Fed funds rate. And obviously my next prediction is when we do it in September, I think it's not going to be a 0.25. It's going to be a 50 basis point reduction. That'll be a total point of a 75 basis point reduction in total from the last two interest decreases. Listen, ladies and gentlemen, we will be at zero faster than most people, most global economists will probably like to perceive, especially the ones that are feeding out the mainstream media narrative of there's nothing to be fearful of. Ladies and gentlemen, there's absolutely everything to be fearful of at this point of life. As I've just mentioned, historically, and we're going way back here, you know, over the last 8 to 9 cycles, when the Federal Reserve have reduced interest rates, 6 months later, a financial crisis has followed. Now listen, it's August. It was at the end of July, obviously, when we had the rate reduction. I think it might have been the 28th, 29th. Don't hold me to that. But we had the rate reduction nonetheless. We had the tightening, and we had the interest rate increases, and then we had the pause in March, and now we've had the first reduction. We're going to have the second reduction in September. And listen, we will be at zero a lot sooner than many people think. And all you need to do is ask yourself the simple question: if the global economy is in such great condition, why are we asking for crisis monetary policy you know, introductions? We've got Donald Trump screaming at the Fed, we need lower rates. Now obviously the mainstream media narrative, well, we've got other global currencies being devalued, we need to lower our interest rates to keep in line. Listen, it's all the bullshit that. Obviously it does stand firm to some regards. Obviously you've got China devaluing their currency. Now you're going to probably more than likely see the Federal Reserve and the United States act by having a further point reduction, and they're going to blame it all on that. But listen, this has been panning out for years, way before the trade war's been going on. The direction of this, if you look on interest rate graphs, and if you look at the previous financial crisis, you'll probably see interest rates at 17%, then reduced down to 12%. And then you'll see obviously the cycle of growth, and then you'll come back down from 12 down to 6, which was where we stood at 2008. We've gone down from 2008 from 6-7% to 0. We've raised from 0 to 2.5, 2.75 for the Federal Reserve. We paused, and now we're going back down, and we're going to be hitting 0, potentially going into negative rates across the board. You know, it's unbelievable what we're seeing in the world today. You've got trillions of dollars in the bond market. You know, we're seeing the US equity markets absolutely hemorrhaging yesterday or the day before, and we've got all the investors flocking to the bond market. You know, we've got investors now as safe haven, obviously alongside gold, but the majority to the bond market. literally putting their capital into negative yielding interest rate bonds. It's quite a marvellous thing that we're seeing. The yield curve inversion, the 10 to 30 is widening, and we're going to see systemic crisis sort of scenario unfolding over the next 6 months. You know, I've never been as certain as I have been certain today when I'm coming to you when I'm talking about this, but ladies and gentlemen, honest to God, we're going to see it happen again historically over the last 9 cycles. Every time the Fed have decreased rates, 6 months later we have hit recession. The only difference being this time, I mean, we've got Brexit coming up in October. That's going to be a catastrophic effect, especially if we leave on the 31st of October with a no deal WTO terms. We're going to see absolute mayhem in the European markets. We've got the US-China trade war, which is being absolutely inflated by the media. There's so many varying factors that are going to contribute towards this absolute global largest crisis we've ever seen. You know, we're living a bubble on top of a bubble on top of another bubble. You know, this is the mother of all bubbles. It's unsustainable. You know, the interest rates for the Federal Reserve got to 2.75 until the market started pouring out of the US equity markets. And we know how important that is for Donald Trump leading up to the 2020 election. He needs to have that strong stock market, which is obviously distracting everybody away from the weak economic numbers. So obviously my predictions moving forward, I'm expecting a 50 basis point reduction in September. I'm actually expecting another rate reduction as well before the end of the year. That will be 3 rate reductions. Remember at the end of 2018 he was talking about 3 rate hikes, and it got to, you know, they just simply could not sustain it. We're now obviously back into an easing cycle, QE4, and the amount of capital that will be needed to keep everything inflated and keeps everything propped up is going to take more capital than Q1, 2 and 3 combined all together. I expect us to be hitting zero soon. I expect us to be in full recession in the next 6 months, which will have felt perfect for my predictions throughout the last 18 months, which is obviously the Q4 2019 to Q2 2020. Obviously the people that have followed our channel will know that is a fact that I have always stated. I've never changed the goalpost, and ironically enough it looks like everything is falling into that sweet spot. It's obviously that I'm not hoping to see people get put out of jobs and lose homes and stuff like that, but listen, we're in a false economy, and until we reset to a fair value, then the charade will continue to go on, and the pain will only get that much worse. So that's obviously the economic outlook. There's a lot of stuff that I would like to speak about. I'm going to try and keep the video length down though on this one. Obviously we've heard the stuff with the Fed now, which is really promising really, because obviously we've now got the world reserve currency, the United States dollar, and their respective central bank now going for a real-time payments initiative through the central bank, which is going to be for interbank settlements. Now a lot of people need to get this obviously into the minds. We've spoke about this through documentaries, so we really shouldn't be getting confused at this point. The Federal Reserve for all domestic transactions and settlements will be similar to what we see here with CHAPS in the UK and our faster payments. It's going to be interbank settlement. So obviously there's a lot of people that runs on Ripple. It's going to use XRP. Listen, this is just the upgraded central banking network for the United States. It's not been done for over 40 years, and they're now implementing a faster payments. It's exactly the same as the UK, so all banks payments can be done on the same day. But what it does offer as an opportunity to the Internet of Value is we're going to have that connectivity potential now when it does go to cross-border settlements. We're going to see the private sector being able to be involved and have a direct account with the Federal Reserve, exactly like what we've seen with the Bank of England. Obviously for the people that have followed this channel, they should really have this into their head now. We're going to see RTGS systems settling domestic faster payments like the UK, like the European TIP system, like FedNow. But what we're going to see with the demand from faster payments is a demand for faster settlements when it comes to moving the value from one RTGS system to another RTGS system. If you remember what Bob Way said, once you've got 2 central banks using this technology to move funds from one RTGS to another, the rest of the world will follow because of the major advantage that we are seeing. So that's something to look forward for. Don't start getting excited. Listen, It's fantastic that America is now being proposed with faster payments for domestic interbank settlements, but obviously with the upgrade of this RTGS system, just like the Bank of England was trialling out the Interledger Protocol, I'm sure the Federal Reserve will also be going down that same route for connectivity for each RTGS system to be synchronized with each other, and that's the end game here. And to see America, what they're doing, especially the Federal Reserve with the FedNow initiative, this is exactly what we want as Ripple, as XRP holders, as Ripple fans outright. We are. I know people all say, oh, it's not Ripple, it's XRP. Fuck that. Listen, we're rooting for fucking Ripple with this one here. And what we're seeing with the central banks, we're seeing the upgrading of the RTGS systems, which we spoke about, which we all knew about. It's something that the Bank of